The 2008 financial crisis was a turning point in modern history. It was a crisis that shook the world and sent shockwaves that are still being felt today. If you think the crisis is just a distant memory, think again. The effects of the 2008 financial crisis are still being felt in every aspect of our lives, from the job market to the housing market and beyond. So, how exactly does the 2008 financial crisis continue to affect you today? That's what we'll be exploring in this video. Hello guys, and welcome back to the channel. In this video, we'll delve into the causes of the crisis and how it spread, as well as the lasting impacts it has had on the global economy and on everyday people like you. Get ready to learn about the ways in which the 2008 financial crisis continues to shape our world and how it affects you in the present day. The economic crisis of 2007 to 2009 was severe and prolonged enough to earn the moniker the Great Recession. And it was followed by a recovery that by some standards was lengthy but extremely sluggish. When the U.S. housing market's decade-long rise peaked in 2006 and residential development started to decline, the so-called Great Moderation came to an end. Losses on mortgage-related financial assets started to put pressure on international financial markets in 2007, and the U.S. economy entered a recession in December of the same year. That year, a number of big financial institutions went through financial difficulties, and there was tremendous volatility throughout several financial markets. In response, the Federal Reserve offered liquidity and assistance via a number of initiatives with the aim of enhancing the efficiency of financial institutions and markets, and in turn, reducing the damage to the U.S. economy. However, the economic downturn became worse in the autumn of 2008, and it eventually got bad enough and lasted long enough to be called the Great Recession. Although the U.S. economy reached its bottom in the middle of 2009, the recovery that followed was, in some respects, extremely delayed. In response to the severity of the downturn and the sluggish speed of the accompanying recovery, the Federal Reserve has offered monetary accommodation at a level never before seen. The financial crisis also prompted a number of substantial banking and financial regulatory changes, as well as legislation that had a considerable impact on the Federal Reserve. After a protracted period of growth in U.S. house building, home prices, and housing loans, the recession and crisis occurred. This growth started in the 1990s, continued unabated through the recession of 2001, and picked up speed in the middle of the 2000s. The average house price in the U.S. more than doubled between 1998 and 2006, the largest rise ever seen in the country. While other areas had much greater increases, residential investment increased from roughly 4.5% of U.S. gross domestic product to about 6.5% over this time, while home ownership increased from 64% in 1994 to 69% in 2005. Between 2001 and 2005, employment in industries connected to housing contributed for around 40% of net private sector job growth. A rise in home mortgage borrowing by U.S. families coincided with the growth of the housing industry, from 61% of GDP in 1998 to 97% in 2006. U.S. household mortgage debt increased. The increase in mortgage debt seems to have been caused by a variety of causes. The Federal Open Market Committee kept the federal funds rate low during the period following the 2001 recession, and some observers have hypothesized that the Federal Reserve helped the housing market activity by keeping interest rates low for a prolonged period and only gradually raising them after 2004. Other researchers, however, contend that these elements can only partially explain the rise in home activity. Furthermore, there's a chance that the historically low level of interest rates was partly a result of enormous savings hoards in certain developing market countries, which served to lower interest rates elsewhere. Others claim that the rise in borrowing is a result of the expansion of the market for mortgage-backed securities. If a borrower was seen as a high credit risk in the past, possibly due to a bad credit history or the inability to make a sizable down payment, it was difficult for them to get a mortgage. However, lenders that repackaged high-risk or subprime mortgages into securities throughout the early and middle of the 2000s provided these loans. The end consequence was a significant increase in the availability of housing finance, which fueled the following rise in demand that drove up house prices throughout the country. The Federal Housing Finance Agency House Price Index indicates that home prices peaked in the beginning of 2007. Since large declines in home prices were thought to be likely to result in an increase in mortgage defaults and higher losses to holders of such securities, this question became important for the pricing of mortgage-related securities after that. In the U.S. historical statistics, significant, countrywide drops in house prices had been rather uncommon, but the rise in home prices had also been unparalleled in its size and extent. Ultimately, nationwide house values decreased by an average of more than 5% from the first quarter of 2007 and the second quarter of 2011. Home price declines like this one contributed to the financial crisis of 2007 to 2008 because it left financial market players very anxious about the likelihood of losses on assets linked to mortgages. As money market investors became cautious about exposures to subprime mortgages in August 2007, pressures started to arise in several financial markets, especially the market for asset-backed commercial paper. Bear Stearns, an investment bank, was purchased by JPMorgan Chase with help from the Federal Reserve in the spring of 2008. After Lehman Brothers declared bankruptcy in September, the Federal Reserve supported AIG, a significant provider of insurance and financial services, the next day. The Federal Reserve, the Treasury, and the Federal Deposit Insurance Corporation all received requests for assistance from Citigroup and Bank of America. The growth of central bank credit in reaction to the crisis was not limited to the assistance provided by the Fed to particular financial firms. The Fed also launched a number of brand new lending initiatives that supplied liquidity to assist several financial institutions and markets. These included loan programs created to provide liquidity to money market mutual funds, the commercial paper market, and a credit facility for primary dealers, the broker-dealers who act as counterparties for the Fed's open market operations. The term asset-backed securities loan facility was also launched in collaboration with the U.S. Department of the Treasury. Its goal was to make it easier for individuals and companies to get credit by providing credit to U.S. owners of high-quality asset-backed securities. In order to prevent a rise in bank reserves that would cause the federal funds rate to fall below its goal as banks attempted to lend out their surplus reserves, the Federal Reserve first funded the expansion of its lending by lowering its holdings of Treasury securities. However, the Federal Reserve was given the power to compensate banks for their excess reserves in October 2008. This reduced the need for the Federal Reserve to balance its increased lending with decreases in other assets by encouraging banks to hang on to their reserves rather than lending them out. Not only did the property market drive the financial crisis, but also the decline in overall economic activity. Both home construction employment and residential investment reached their peaks in 2006. The National Bureau of Economic Research labels December 2007 as the start of the recession, which is when the entire economy reached its high. Initially, the reduction in general economic activity was rather slight, but when financial market stress peaked in the autumn of 2008, it became much more pronounced. The U.S. GDP declined by 4.3% from the peak to the bottom, making this the worst recession since World War II. With a duration of 18 months, it was also the longest. From less than 5% to 10%, the jobless rate more than doubled. The FOMC reduced its federal funds rate objective from 4.5% at the end of 2007 to 2% at the start of September 2008. In response to deteriorating economic circumstances, the FOMC hastened its interest rate reductions as the financial crisis and the economic downturn worsened in the autumn of 2008, bringing the rate to its effective floor, a target range of 0 to 25 basis points. By the end of the year, the Federal Reserve also launched the first of many sizable asset purchase programs in November 2008, purchasing mortgage-backed securities and longer-term Treasury securities. These acquisitions were made with the intention of lowering long-term interest rates and generally improving financial conditions, which would stimulate economic growth. Although the recession officially ended in June 2009, the economy remained poor. In the first 4 years of the recovery, economic growth was relatively modest, averaging about 2%, and the unemployment rate, in particular the percentage of long-term unemployed, remained at historically high levels. By convincing the public that rates would remain low at least until certain economic conditions were satisfied, this tactic, also known as forward guidance, was meant to pull longer-term interest rates lower. Subprime mortgage borrowers finally defaulted in large numbers. When they were unable to pay, financial institutions suffered greatly, but the government intervened to save the banks. The crisis had a significant effect on the housing market. Within a few months, evictions and foreclosures started. In consequence, the stock market crashed and some large corporations failed, losing millions of dollars. Naturally, this led to massive layoffs and protracted spells of unemployment around the globe. International commerce slowed to a crawl as a result of declining credit availability and waning trust in financial stability, which led to fewer and more cautious investments. Thanks for joining us for this deep dive into the lasting impacts of the 2008 financial crisis. We hope you now have a better understanding of how this event continues to shape our world and how it affects you today. Remember, the financial crisis may have happened over a decade ago, but its consequences are still being felt in many aspects of our lives. If you found this video informative and insightful, don't forget to like and share it with your friends and family. And if you haven't already, be sure to subscribe to our channel for more informative videos like this one.